All right, one last look at the disclaimer before we get started. What are we going to be talking about today?
Yep, so let me grab my screen quickly. Hold on. I'm going to continue on our previous conversations, looking, we used SPY as our example, and we analyzed single leg option trades. And a recap really quickly is that when we look at option trades, um, you could enter in, a buy or sell a call or put option. You could also enter in a multi-leg trade or complex order where you set up a strategy like a call spread, you enter it in, and that requires that both legs get filled simultaneously with the conditions that you entered. So this is only looking at those single leg trades, and then it's performing different analytics on those trades. And up here, we talked about these different types of analytics. And I think what we did was come down to this table yesterday. And on this table, let me just expand it. This table over here organizes the analytics by the different options expirations that are available to trade in SPY. So to the left-hand side, these are the different expirations. These are the expiring dates. And as you can see, right now we have them in order from the shortest dated options to the longest dated options that go all the way out to December 18, 2026. Now, for each of these expirations, we provide some summary statistics of, the option activity and how the options themselves were impacted on the trading day. So you'll have option activity like trading volume, calls, puts, all that. And how are the options impacted? Are they the premiums moving up? Are they moving down? What does the skew look like? So those are the things that we started to talk about yesterday. And let me just go out. I think we're doing the August 16th expiration. I'm going to click on it. And a couple insights that we could grab from this table are the following. Here we see where the at the money implied volatility is for each expiration, right? So August 6th, August 6th, this is the 0DT. This expired yesterday. So that went away, but you could see here that was by volume the busiest or had the most trading volume out of all the expirations yesterday. You can see 50%, or a little bit over 50% of all the trading volume was just in this one expiration, August 6th. So it gives us an idea how people are using the options in SPY. And this gives us the percentage of total volume in the single leg trades that accounted for in this expiration. All right. Let me see if this, I'm going to just narrow it down to the top 10, just the first 10 expirations. Then we also get these summary stats, which help us get an idea how the options react. Okay, did the option premiums go up or down, and how the skew changed from one day or the next, or how the skew looks like. So we did talk about this, and I'll just do a quick recap. If we see that the at the money strike is 23.2 implied volatility, well, that doesn't mean that every strike is 23.2. We refer to it as a skew. If you look at the implied volatilities of different strikes and different options, they're different. They don't have to be the same. And we've referred to that as an implied volatility skew. Now, because there's so many strikes, it's hard to define the skew with a metric. So we'd have to like standardize a way of looking at it, right? Because I'm just going to kind of come down here. And here's the graph of August 16th expiration. And you could see there are a lot of different strikes. Here, you got 470, strike 480, 490, and then strikes in between, right? And I could expand this if I wanted to. Look, I could expand it to all the way up here, right? Let me narrow it down. I could expand it all the way out to down here. So there are a lot of different strikes on this expiration. And just visually, we could see that there's trading volume that is happening on many of these strikes. These bars here, they show you the trading volume on these particular strikes. So on August 16th expiration, I could hover over this and I see the 555 strike. There's 5,982 calls that traded total on the day that were single leg trades, right? These are not included multi-leg trades. Single leg trades, 5,982 calls for a VWAP price of 22 cents. Okay, volume weighted average price, 22 cents. And that's the yellow bar. And we see that there's a blue bar up top. That's the put volume. 564 contracts traded in the puts for a volume weighted average price of $29.88. Of course, this put is in the money, right? The 555 strike the put is in the money. The call is out of the money, right? The stock is trading, as of yesterday, 522. So 555 strike is way above 522. Now, let me go back to this. This is by expiration. And visually, we could also see how the volume was distributed within this expiration. If the blue bars represent put volume, the yellow bars represent call volume. Just visually, it's noticeable, okay, as the strikes go lower, right? To the left, the strikes are going lower. To the right, the strikes are going higher. As we go lower, it seems that most of the trading are in the puts, right? There's a lot of volume, but it's mostly in the puts. And a couple strikes kind of stand out here are the 500 strike and the 460 strike. So those two strikes kind of stand out. Keep in mind, we're only filtering out single leg trades. So if it was entered in as a spread and executed as a spread, it's not included in this volume. And here I'm just looking at the 460 strike. We see 18,184 puts traded for VWAP price, volume weighted average price of 57 cents. Gives you a sense of not only when you're hovering over it, not only the volume, but also, the premium in the options, the weighted average premium that it traded at, 57 cents. That's in the 460 put. Go to the 500, we see 17,767 put contracts traded for a VWAP price of $2.15. So without even going to the options chain and whatever, we could get a quick visual of how the trading volume is distributed. We could hover over it, get a sense of like where the option premium is. And just visually, we could see how the put and call volume look like relative to each other, right? And even distributed amongst different strikes, right? So it's very, it it's clear to the downside, it's mostly puts, right? That from the blue bars. And as you go to the upside, it starts to look like mostly call options. Okay. Maybe, like a bomb D strikes, 535 and so forth. And if you even go out further, you could just hover over to see if there's any premium in these, like, 574 cents, 7 cents, 12 cents. That's the average price that they traded at, volume weighted average price. So that's visually we see it. And on the same graph, what would be the next question we have now that we see the volume and how things are trading and prices? How are the option premiums impacted? Right? Are implied volatilities going up? Are they going down? What does the skew of the implied volatility look like as we go, around strikes around the money's going up, going down? So that's the other question, we may have. Here's the volume. How are the options impacted? Well, that's what these two lines are. Those are the implied volatility lines. And we start out with this solid line here. This is the implied volatility from the previous day. This solid line. Okay. And this gives us now a reference, right? A reference to compare yesterday's to what's going on today or the most recent. Just like, if you got all this volume, you want to see, well, did the stock go up or down? Right. So you'd have to say, well, where did it close yesterday and where's the stock now? Right. So like, think of it like this. The stock is up 1.2% in pre-market. But what does that mean? Up 1.2%, you need a reference price, right? It's not up 1.2% from last year's price or 1 month ago or, for 1 minute ago. We need a reference to say, well, how did the stock change? And to do that, we have to reference where the stock was at some point in time. So the standard is to look at yesterday's close, right? The previous day's close, where is it in the pre-market? Even after it opens, where did it close yesterday? So if we look at, the closing price versus the most recent, we could get the change. So that's the idea behind the implied volatility, but unlike a stock, there's only one SPY stock, right? We don't have SPY 1, SPY 2, SPY 3. There's one SPY stock. But in options, we have different options. They're derivatives. We have lots of different options that are available to trade on SPY, right? Expirations, strikes, and so forth. So how do we see how the options change, right? Let's go back down here. And this graphically, we could draw a solid line to say we're going to use the implied volatility from the previous close. That's what we're doing now. We're looking at the implied volatility of each of these strikes from the previous day's close. And then we're going to say, well, how did it change? Well, where's the implied volatility now? Right? That's where the change is. Where's the implied volatility now? Now, this is from yesterday. This is yesterday's close from the previous day's close because we're not open yet, right? So this new line, see the dotted line? That's the most recent implied volatility. And when it's down, we indicate that by putting a red dot. If it was up, we would put a green dot. So it's obvious here that the entire implied volatility, the whole implied volatility line shifted lower. The entire thing shifted lower on every strike, right? So we don't have, greens up here, reds down here. All of them are red, and you could see the wide gap distance. So there's a significant shift in the entire implied volatility curve lower, okay, yesterday. Another observation is that it's not a straight line, right? This implied volatility, it's not a straight line, like let's say all 30, right? This is 30 vol. So if it was a flat skew, we would see a straight line, but we don't. We see a kind of downward sloping line as you go up higher and higher in strikes, right? In the opposite direction, it's an upward sloping line as you go down in strikes. So there's an implied volatility skew here for sure. The skew indicates that if the stock goes lower, the expectations are the volatility will increase. If the stock goes higher, the volatility will decrease. Right? That's what the line is indicating, based on that skew, right? Because people are willing to sell lower and lower implied volatility as the stock's moving higher, but they demand higher and higher implied volatility as the strikes are going lower. So that's the one takeaway. And then the other takeaway is just looking at it eyeball. I can't tell for sure, but it looks like the shift in the implied volatilities looks that there's a greater shift on the downside puts than there were on the upside calls. Okay, it could be just because that's anyway the skews that way, but it looks like the distances from here to here are greater than from here to here. Okay. So let's go look at it now. If we had to just reference numbers, right, metrics. So this is how it would look. On August 16th, we see that at the monies are 23.2. So if we wanted to just get a sense of what the implied volatilities are doing if we win strikes lower, and what are the implied volatilities are doing if we win strikes higher. So here what we're doing is saying let's standardize it and reference the 25 delta put, which would be a put that's below the at the money, and a 25 delta call, which would be a call above that at the money. Okay. Here, 25 delta put, 25 delta call. And the idea there is saying if we ran a straight line, 23.2, so this line here that's curved, if we ran a straight line, 23.2, and then compared the strikes, where is it actually versus 23.2? Where is it relative to that, the money? And if there's a difference, then we want to know, well, what's the difference? So we're doing it in percentage terms. So you can see here that this 25 delta is saying that the 25 delta call is actually 12% higher than that, the money. So implied volatility increased as we went down to the 25 delta put. Well, what about the other side? What about the upside call? So here, this is saying that the call, 25 delta call, implied volatility is 18.5% lower than the implied volatility of the at the money. So now we get two relative values. 25 delta put, 25 delta call relative to the at the money. So we kind of get a sense that, yeah, most likely the implied volatility curve looks like it's sloping up to the downside, sloping up to the downside strikes, sloping down to the upside strikes, which we could see here graphically too, right? But this table also just lets us compare on a relative basis the other, all the other expirations in front of us, and also you could compare SPY to QQQ and whatever. So we've got that. And then the next thing is, okay, now that we know what this is, right? We know what these are. How did they change, right? Remember the change, right? How does it change from one to the other? So we So coming back down here, we're like, okay, well, let's look at these numbers today. The at the money IV strike, the 25 delta put strike, the 25 delta call strike. Let's compare exactly those options, where they are today, where those options were yesterday. And then let's see how much it changed. So here you could see that the implied volatility on that same strike decreased 20% for the at the money. It decreased 20.3% for the 25 delta put, and it decreased 20% for the 25 delta call. So it looks like they, at least for the 25 delta and at the money, they had a similar shift, all across the board, about a 20% decrease in IV on those August 16th expiration. So I think we're right up at 9:30. I'm going to stop right there and continue
Awesome
tomorrow.
job, D. Thanks as
Yep.
always, buddy. You have
All
a great
right.
trading day.
Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trading peace, chameleons. Everyone